This episode actually comes with a bit of a warning to take action to secure real bullion as soon as you are able.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects of the global economy in these historic times. My name is Shane Moran, and I'll be your host for this week's episode, and you will be joined very shortly here by the one and only precious metals expert and whistleblower, Mr. Andrew Maguire is in the house, and we're going to pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. Get ready. I'm telling you right now, I'm warning you, get ready for a blockbuster episode here of Live from the Vault. Again, we're bringing you knowledge and understanding, and that's something that the mainstream media won't provide. And with that, let's head over to the UK right now and talking gold with Andrew Maguire. Hey, Andrew, as usual, let's start off today by picking up the thread from our last market update. It seems so long ago, 2 weeks. It just seems like it's been months ago, but I know that your focus is on exactly where we are in the Fed-driven, paper to physical battle that we're talking about on every show. As the Fed is unprepared for a globally driven gold revaluation, let's start off today by bringing us up to date on what's happening here in this battle.
Yeah, great to be with you, Shane. Great to be with everybody again. Let's get going here because there's a lot to get through. And as you say, this is the Fed is on the back foot. So following a very, very close shave this past weekend, we'll get into that in a second. This episode actually comes with a bit of a warning to take action to secure real bullion as soon as you are able. Now, we'll look at that, as I say shortly, but to answer your question, Shane, in our last episode, we looked at how and why competing global central banks are busy accruing physical gold to add and bolster their gold reserve accounts, while the Fed is caught out as the outlier. We went through the reason and how that is obvious last time. They're extremely behind the curve. And as we discussed last time, there's very little doubt a gold market revaluation is inevitable and imminent, and that it is the Fed that is running out of tools to keep a synthetic cap on the price of gold. And of course, the same actors in silver. And this is all happening into an increasingly liquid global physical marketplace. So the question is, where are we as we approach this pivot point, which could be triggered by any one of a number of black swan events? While some are on the radar, such as Taiwan, NATO, escalations against Russia, and we came very close to something being witnessed over the weekend. And what we're saying is some tail risks are completely unfactored. Now, as a refresher, for a central bank to tap into, this is how simple it is, for a central bank to tap into their gold revaluation facilities, the GRA facility, it's simply a matter of selling and immediately buying back the same amount of gold for a realized gain. Now, the Fed's hair trigger to revalue gold will be when they are forced to follow a race by other global central banks moving in sync to utilize their gold revaluation account reserves. And it would be implausible for the Treasury to continue to value 8,133 tons of gold at $42 an ounce, when a global race to revalue may gap the price of gold up into the 2,000s, if not as high as 6,000 per ounce. These are all liquidity provider projections based upon current footprints. Now, the black swan revaluation trigger would happen without warning, and as would always be the case, implemented over a weekend.
Now, Andrew, can you share with us, let's go into maybe a little bit more detail of how close did we come to a black swan event this weekend? I know some people are informed, some people have no idea what we're talking about here. Maybe just go into a little bit more detail.
Yeah, Shane, really glad to. If, for example, the Russian nuclear arsenal had changed hands over the weekend into the Wagner militia control, and there is no one credible that could discount this could have happened. Nobody knows the situation other than a few insiders in Russia. What would have happened? Gold would have moved bid only in the paper markets on Monday morning, completely dislocating the gold physical price from the COMEX cash settle price, with spot gold now Basel III NSFR compliant. And unlike March 2020, when gold did go bid only with the Fed able to rescue the naked short market making banks, this time with liquidity providers fully compliant and having the physical to deliver, which they didn't back in March 2020, the Fed could not halt a real physical price emerging. Only physical gold would be sought, and the price would only stall at a level that reflects a true supply-demand price. Now, if you're bid only, it's going to be a hell of a gap higher. Now, it's this simple. The COMEX would go bid only and be halted multiple times while the physical markets force the NSFR compliant price of gold hundreds of dollars higher. Now, spec shorts would be wiped out. The Fed can print their way out of it by revaluing gold, despite the Treasury gold they manage being rehypothecated, which we've talked about. The rehypothecation issue completely separately and showed empirical evidence of it. This is a separate issue. And as long as the Fed was in sync with all the other global central banks revaluing gold, the extent of the 8,133 tons of double ownership would not be discovered. Much better than not revaluing. And with US traders unable to access the NSFR compliant physical markets, guess who will be on the long side? So really had so many questions on this as far as the COMEX, what happens to the COMEX longs, and then of course the long option speculators, how would they be dealt with? And the CME will not want to allow a complete default. Forcing a lack of trust against all their products is not an option yet, but it is possible to call a force majeure on the ability to take physical delivery, and longs may well be cash settled, but almost certainly at the prevailing physical gold price. Now, if the price was allowed to be frozen on the COMEX would be finished. Let's not forget that every single one of all the first tier banks are following the BIS and in step with the global central bank race into physical and are net long physical gold. We have been talking about this for at least 18 months. The Fed can print their way out of any shortfall following revaluing gold, but they'd still have to revalue gold. But the naked short specs will experience unlimited losses with no way out, and that's far more than they would ever have invested to short the product. So unlimited losses. So with the warning made, let's step back and look at the counterintuitive June market action and how, under the smoke and mirrors officially driven COMEX action, the expanding disconnect between what is 100% confirmed by first-tier global liquidity providers as triggering the largest central bank gold buying since the March 8th, 1813 lows. This is a big event. Liquidity providers also confirm that insider commercials are now making a concerted effort to cover up a large overhang of T+2 delivery exposure. Remember, all that means is that when you buy a spot contract and it is backed fully by physical under Basel III and NSFR compliance, then it has to be delivered in 2 days. So there's this, once you play this game, there's an overhang of these deliveries that come to market. Now, notably, this wall of central bank buying was evident this time at a stair-step $105 higher than was evidenced just 3 months ago in March. So as these central bank buyers raise their appetite for physical gold, this beggars the question, who is left holding the naked short paper gold bag? And as we drew attention to in our last market update episode, that was just 2 weeks ago. Yes, Shane, unbelievable. These official chart painting attempts are limited to exactly how many of the old guard, which are the led by the nose speculators, that are forced to trade inside the rigged casino environment that can be tricked into taking what is really just the dangled bait, so as to enable the Fed to offset what we'd identified as the largest lineup of central bank sized buyers liquidity providers had evidence since these March 13 lows. Now, although the Fed's learned strategy of the best form of defense is attack, in this case, liquidity providers indicate this may have been a miscalculation. And for reference, this was prior to the rising central bank stair-step level, which had triggered the last leg of this aggregated central bank buying, forcing commercials to quickly ring the register on these speculators. And then we had a $190 rally back in March when this exact thing happened, and it ran into first resistance at 2003, which is pretty much where first resistance still is. Without any meaningful pullbacks, though, and we're talking about a pretty rapid rise. Now, after a small pullback, the gold price rose another $80, so into the 2085 level. So that was a net $270 move. So, don't give up, guys. This is this gaming that we've just witnessed in June, and we'll go through a little bit more and why, but don't be thrown out by this. This is just what we saw back in March. And as can be evidenced by the impossible to ignore whale wholesale market footprints, official gold containment efforts are increasingly running into very strong competing unleveraged central bank and sovereign physical buyers. So we're talking a leveraged sale of paper into an unleveraged purchase of gold, bullion. So anticipating a wrong-footed Fed strategically pre-positioning their bids at known aggregated spot gold bid levels, essentially, this is what the sovereigns did. They knew exactly what the Fed would be forced to do, and that they can see the fact that the Fed, especially when you've got a very heavy Fed infested week, which we just saw 2 weeks, in fact, where we saw Powell, we saw multiple hawkish guys coming out. And yes, of course, and then we see these politicized beats, news beats. And so really, what are they doing? They're not stupid. Of course, they're going to sit back and pre-position themselves. But based on the footprints, liquidity providers reported that last week's very thin market overshoot of the central bank tonnage size spot bid levels was very likely a cartel miscalculation. You have to say, be careful what you ask for, guys.
Well, can you expand on this miscalculation here, Andrew? This is fascinating.
Yeah, and as we drew attention to in our last episode, when we knew these bids were down there, anyone who thinks the Fed is anything other than a bunch of self-serving bankers would be fooled into thinking that when the Fed instructs its Asian banks to manage fiat gold against the fiat dollar inside this closed COMEX casino environment, that they would know what they're doing. But just take a look around the Fed's missteps and knee-jerk reactions evident in every other market they meddle in. And it just becomes quite clear they are throwing, they're just throwing the proverbial against the fan to see what sticks. And not a wise strategy when other central banks know the game and are taking advantage of them. Now, we have Daniela DiMartino Booth, a Fed insider, who is our next returning guest, advising that, and when she was with us last time, she advised that during her tenure at the Fed, she indicated the Fed never, ever discussed gold, not once, and that no one at the Fed understands it as an asset class. Now, following physical gold being revalued as a first-tier cash equivalent, and this is a question I'm going to ask her about, and this was revalued on the 1st of January of this year, we've illustrated how and why the Fed entered this year on the back foot. And the major footprint since then exposes the Fed as the only global central bank trying to contain the price of gold and maintain a paper gold illusion. And while the Fed is forced to manage gold inside this non-compliant, cash-settled COMEX futures market, every other global central bank without exception, including the Bank of International Settlements, Russia, China, BRICS Plus, and several African nations, are all openly adding both published on-record gold purchases, records, as well as adding much larger unpublished, off-the-record monetary gold reserves, all to back their currencies benchmarked against an overvalued, rapidly depreciating, debasing dollar. But with gold now being recognized by an expanding group of siloed COMEX speculators as a first-tier asset, it's created a growing split in how historically these easily gamed speculator groups, and how this speculator group is actually unraveling the 95% win-lose house odds to neutralize. And what they're doing is they're actually neutralizing every trade that they take as a first-tier hedge, neutralizes it completely. And as a result of these speculators increasingly employing gold as a component of their suite of risk-on hedging tools, this group of speculators will not be rinsed out of their paper gold positions on a rigged price decline, which we are constantly seeing. Gold hedges, alongside cash and bonds, etc., will be acting as the fire insurance it was actually purchased for.
Wow. Well, Andrew, we've had a lot of amazing feedback from the Live from the Vault community. And by the way, if you're watching this show and you haven't hit that subscribe button, do it now. But we're talking about an important split in the speculator category. And now this bullish effect looks to be unfactored at this point. Is that correct?
Yeah, Shane. And goodness me, I mean, using the COMEX futures exchange for what it was designed to do, hedge risk, my goodness me, what's going on? So bottom line, the Fed, relying on the COMEX to leverage gold to attack these siloed clients, are finding that the 50-year window to do so is rapidly shrinking their ability to do so. Yes, there's still enough to cause volatility, but not to the degree that they used to have. And remember, as we've illustrated into every Fed-driven event, the dangle bait to buy dollars and sell gold into a dollar index rise consists one part of an unbacked, rapidly depreciating fiat dollar, and then selling an equal amount of fiat gold, both consisting of branded casino chips played at the pit manager's rigged tables. Now, these chips are valueless outside the casino and can only be cashed out as dollars inside the casino. So people who think they're trading gold are not trading gold. They're trading a move in gold. However, it's important to understand that while this 95% house-rigged win-lose action is corralled inside the illusionary world of the COMEX casino, we spent a lot of time looking at it last time, global players, that is non-US traders, that are able to operate outside the casino have entered the back door and are able to use that mechanism we call the exchange for physical mechanism, which is just simply a question of taking legitimately taking a COMEX fiat gold position and converting it into a spot gold deliverable position, and unfortunately, the House is forced to keep this EFP mechanism open as much as they'd love to slam it shut. But if they did, then really the whole game would close. And so what they're doing is they're selling these fiat dollar chips in exchange for physical gold bars outside the COMEX. Now, this is what the central banks are accessing. And as we drew attention to last time, this is Nixon's gold for dollars window reopened. And under the chart painted illusion, global traders are recognizing this is the slippery slope that will ultimately force the COMEX to reflect a real physical price, and why this is an opportunity to be seized before a real gold price emerges during this year. Now, the volume of these unbacked fiat trades that can be siloed and subsequently squared off inside the casino, and this is the important part, versus how much of this freshly generated fiat gold escapes out the back door through the EFP facility, which the US-based casino traders are banned from using, remember, it is the exact pivot point that the Fed has to cover the paper bets. They cannot just continuously, they are forced to deliver. They don't have the bullion to deliver. The moment these EFP outflows hit the 10 times larger Basel III NSFR compliant deliverable spot gold markets, this fiat gold must, and I mean must, be converted into physical gold bar for delivery. The Fed has nothing to deliver. This rigged casino environment is increasingly forcing the house to dance around these very large Basel III compliant EFP outflows, which, while the Fed will continue to inject short-term volatility, it will continue to limit the downside while forcing a higher price in 2023 to progress. And this is not just about accumulating wealth. First and foremost, this is about wealth protection, wealth preservation, which a plus 5,000 years of back testing in gold proves it's the only asset class on this planet Earth, other than silver, that can protect you against these self-serving bankers.
Well, Andrew, this really looks positive, I would suppose, in 2023 for anyone holding physical and not paper pretend silver or gold. But maybe you can bring us up to date on what people can expect. They're watching the show and they're asking themselves the question, what's happening like right now, what to expect?
Yeah, and so, yes, short term, obviously. So let's look at where we are following what was, again, a Fed-infested 2 weeks. And you could just look at the chart and see the Fed was active. That was since our last episode, this is. And with Powell largely now in the rearview mirror, having already spun the mantra, so what we see is what to expect as we enter the July trade is what we need to look at. Now, we're recording this on Tuesday as we head into options expiry today, and where the COMEX July contract, silver July contract, rolls over into the September contract. And that will be followed by first notice day on Thursday, which means that a speculator would have to step up, and an owner of those shares would either have to step up and fully fund that rather than just trade the small amount of leverage it takes to control that position, which means the specs will bail, leaving really just the commercials holding the last contracts after first notice on Thursday. And then we'll see the delivery of this deeply underwater July contract into a massive supply deficit on Friday, which is when this episode will be released. So you'll be seeing it. And the first thing to note is that the underwater option structure that we're going into today is that when silver contract rolls over and goes into delivery on Friday, that these insider market making commercials, thus the COTs as we call them, are on the long side of the bearish spec bets made against gold at 1970 and 2000, and in silver futures at 23.5 and through to 24. Now, this may take until next week for insiders to ring the register on these naked short speculators, but nevertheless, that is their commercial sweet spot. So we're deeply under that. And picking up the action into the heavy 2 weeks of Fed-driven action, the official high-frequency trading directional COMEX-centered naked short sell bots, these algorithms, had waited, if you remember, and this was last week, they waited until to really make the lows, and this is where we think the overshoot happened. They waited until the Chinese exchanges were closed for the 2 days of the Dragon Boat holidays. And then they pulled the trigger in very thin liquidity to ignite what was actually a very aggressive spec long stop hunt. I think they did not factor in, and they did not factor in that the speculators that are now sticky and are using silver and gold as legitimate hedges were not rinsable. Therefore, they lacked as much cover as they anticipated. Now, while the SGE holiday officially commenced on Thursday the 22nd, you have to go actually back to Wednesday because it went from Thursday and Friday through to Monday. The COMEX footprints evidence that the aggressive official HFT selling ignition was actually ignited at the moment the SGE closed shop on Wednesday, the 21st, timing the selling for just after London opened on Wednesday morning. Now, this maxed out COMEX-centric gaming enabled a full Western market 3-day window for officials to rinse out as many specs as they could. However, based on the footprints, liquidity providers reported that the thin market overshoots of the waiting central bank spot gold bidders, it overshot that level, and really it was driven by a massive spec capitulation, but they were unable to cover into the sticky specs. And this is, I know this is, again, this is just maybe a bit technical, but it is actually what happened. However, given the disconnect between the wall of COMEX paper selling and the waiting central bank demand, it strongly suggests this overshoot resulted in a cartel miscalculation. And while the SGE was closed, the PBOC, Central Bank of China, was reported to have been active, locking in deliverable NSFR compliant spot gold for delivery, monetary gold flowing out of the system into China. And while there is no doubt the June gold and silver derivative selling was an officially orchestrated chart painting exercise, it has reached limits that have been pushed the short cover envelope to the absolute extremes required for these agent commercials to be able to equitably ring the register and short cover into a growing overhang of these upcoming T+2 sovereign and central bank delivery demands. Now, this is yet to play out. And as we observed last Friday morning into this paper to physical disconnect, crosses began evidencing very strong concurrent safe haven gold and silver inflows into a strongly rising dollar. Now, that is always a signal. Digging a little deeper, following the Friday Asian Open, what we saw was signs of a distinct change in behavior as this inverse dollar indexed gold and silver correlation reversed for the first time since the March lows. Now, these are the telltale signs we're looking for. Oh yeah, sure, you can see them covering up and papering over it, but that is a sign. And while Chinese markets were absent last week, the PBOC was reported to be behind the very large official gold buying. Now, the fresh dollar index gold silver disconnect, not seen, as I say, since March, reflected that there were sufficient NSFR compliant unleveraged Asian physical buyers to force commercials exposed to a wall of spot gold buying to short cover, sufficient to offset the automated, led by the nose, gold and silver centric sellers, basically, selling into a rising dollar index. That was. There are also credible reports that this PBOC gold buying was a reaction to escalating geopolitical tensions relating to China. And our insiders report the PBOC is readying for sanctions relating to an ever more likely conflict with the US over Taiwan. Now, Biden's dictator comments were not helpful, and while Yellen tried to walk it back last Friday and is probably going to China to kowtow a little bit, it is clear sanctions are being hedged with unreported monetary PBOC gold purchasing, and that is accelerating. And with the rate hike fears spun by Powell and the Fed plate spinners, that's going to continue to weigh on markets and provide a boost to the dollar index. But it's increasingly realized that this hawkish stance also raises concerns that the next leg of a banking contagion will be reignited. And this will assist gold offsetting dollar index strength.
That's amazing, Andrew. Now, I'm not alone here in saying this because I know we have a very large part of our community wants to hear about the strange action that's happening in silver. What's going on there?
Yes, Shane, of course. Look, silver futures, we've covered this before, but they are far more sensitive to the speculator-driven, this inverse dollar silver correlation. So it's, basically one up, the other down. So as a result, with the dollar rising, it's become grossly oversold into a massive physical supply shortage. And as we assessed in our last episode, even though silver is not NSFR compliant, the compliance department of every single first-tier bank, yes, the very same banks that are long gold, and the major first and second-tier liquidity providers are also forcing similar compliance as they do with gold, which places silver in a very similar physically driven short squeeze situation. Now, as a result, on and off ramps, that is the authorized participant gatekeepers in SLV, and you remember SLV is that illusionary exchange where you can actually swap a futures contract, you can short silver in the SLV, but they've been evidenced to be cutting their short positions. Silver supply is in an increasing deficit and consistently being jumped on by Asian and Chinese buyers into the blinkered spec hell current. I've just got the helicopter coming over. Just bear with me. No, they're not coming for me, I think. He's right outside, but never mind. So as we were saying, look, so really what we're seeing is this short covering. And it's because these discounts are being jumped on by Asian and Chinese buyers into the blinkered spec hell current synthetic deep discount. Now, also, given the underwater option structure, which we just discussed, it also indicates a commencement of really a spec short squeeze up and coming with insiders on the long side. Now, bottom line, and we need to get options out of the way. This is a huge mark-to-market event, end of week, end of month, end of quarter. Of course, you're going to see a big options expiry. Bottom line, silver is the most oversold since it bottomed out at just under $20 back in March 2023. And given the supply deficit and very strong Asian Indian demand, it looks very attractive as a buy with a very limited downside. And if you're a stacker like you, Shane, and so what you say, you've already been all over the discount. Well, I guess really. That just leaves one question left to ask, guys. How much physical gold and silver do you own?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our entire Live from the Vault community, buy physical. Make sure it's backed 1-to-1 and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today again on another amazing episode of Live from the Vault. Please help us spread the word about this channel by hitting that like button right there, sharing this information, and also hit the subscribe for sure. Now, if you click on that bell right there, you'll be notified as each episode goes live. And with that, we'll see you next time on Live from the Vault. See you then.